Hi, today joining me I have Ryan Chambers. Ryan is a mortgage banker and also owner of Midwest Capital Mortgage. And we're going to give you the do's, the don'ts, the good, the bad, and the ugly about the mortgage world and how to navigate through those waters. Ryan, thanks for being here today. I appreciate it.
Thank you. I appreciate being here.
So kind of to start off, Ryan, a mortgage broker versus a mortgage banker, can you kind of explain what the difference is there for me?
Absolutely. It's kind of funny. It's a rite of passage. So it's like when you get your PhD, maybe you're like, well, now I'm a mortgage banker. A lot of people start off in the broker space. The only real difference at the end of the day is who controls the money. So a mortgage banker will own that mortgage and fund that loan with their own money. So they are acting as the bank, or they're acting as the true lender and using their money. Then a lot of times in the mortgage world we live in today, the loans all get sold on the secondary market, but a broker will be a broker only. They will act in a advisory capacity only, and they actually don't use any of their own funds. The funds are from another investor at the end of the day, or another actual lender. So they don't get to really call the shots, is the disadvantage of being a broker. They don't get to control the process or the flow, but a lender would actually be lending their own money, so they can dictate and guide the process kind of as they want to.
Yeah, I know in my situation, because in all full honesty and full disclosure, Ryan has done tons of mortgages for our clients over the years, and a lot for myself and my family and different things. And being a business owner, sometimes you run into different situations where a traditional lending agent, maybe somebody just sits at the bank and that's their only product they have, they can't always look at the bigger picture of someone's financial situation. They have to be more in a box, I guess. Can you kind of explain how you're able to help people like myself and others that have a little more of a unique portfolio situation going on?
Absolutely. I think that's one of the things that our company and we do the very best in the mortgage space, in the mortgage arena, is we really truly understand not only self-employed folks, but sometimes more complicated situations, or situations with a lot of moving parts. Since I've been self-employed my whole life, I've never actually worked for another human being. I filed every tax.
Just robots.
That's
right?
robots, exactly. I have filed every tax return you can imagine, every schedule that you can imagine on my tax return. So I kind of have that deeper understanding of the way my taxes flow, and they're complicated. So I can always move that into a client arena and say, okay, well, I understood the logistics of this, so now I can help parlay that over to that. And then really, as it kind of really boils down to, is when you ask the right questions, ask enough questions. I think that's maybe kind of where we're headed. Dig a little deeper. We all fail to do that in our lives sometimes, in truly understanding the situation. That's my secret at the end of the day for clients with a very challenging situation or process or whatever their problems may be or their challenges may be. We just like to find out, what is the root cause at the end of the day? What do you need? How do we get there? How do we bridge it? And then sometimes it takes planning. Sometimes it takes strategy work. Sometimes it takes time, unfortunately, saying, well, we need to do this, and it has to be a procedural thing before we're ready for this. So patience, empathy, understanding, asking the right questions, that's definitely what it takes to get there. And then I have that unique benefit of being self-employed and complicated myself. So I don't judge people for having a complicated life, because I am complicated too. So that's one of the things that makes that a little bit better. I think if you go to insert big bank name here, X bank or X internet lender or X whatever, it's a process for them. It's a procedural conveyor belt of get the loan in, get the loan out, get the loan sold, make the money as fast as they can.
You kind of a fast food type.
It's a fast food. Yeah, it's a great way to think of it. There's they've systemized it, and that's great. We need that for efficiencies in business, to have a system in place to really break down the components of a mortgage process, but at the same time it loses the human touch, it loses the question touch, it loses all that when they're just trying to get the loan through the door, and nobody stops to ask the time, especially the mega banks who, not to discredit anybody who's working for a giant Wells Fargo, Bank of America, Quicken Loans, or one of these places you see on TV.
Sure.
Not to discredit them, but they're earning a salary. They're sitting there in a call center in a cubicle, and they're just trying to get through the computer screen prompts as fast as possible, and they aren't spending that extra time. So that's just kind of one of those things where the system is really designed to either get you in and out as fast as possible, or find somebody who actually truly is going to take 5 minutes and understand it. Because being my own company, I understand that the relationships I have today are going to be the relationships I need to, keep in my life. So I want to treat everybody with that time, and give them that patient moment to say, okay, let's figure your situation out. So,
you've got vested interest, skin in the game. It's a long-term,
Absolutely.
lifelong career for you. So
Absolutely.
Our industry is kind of the same way. We have certain competitors out there that are maybe not fully licensed, maybe don't have all the different tools at their disposal, things like that. So definitely a big difference between someone who can do the full-blown planning and consultative approach that you take where needed.
Not that it's it's a fabrication of myths like we all think, because it happens in your industry a lot. It happens in our industry a lot. They're talking about, the computers and the robots are going to take over, and you're going to have this automated, in your case, maybe portfolio that's nothing but AI technology that's going to rebalance every 30 minutes, and you'll never have to talk to another advisor or human again. Well, that works until it doesn't.
Right.
And then when you want to talk to a human being, you go, well, that's great, this computer did this, and then they messed up, and now my goals aren't aligned with the computer's goals. What do I do? Well, they want to call you, and they want to talk to you, and they want to understand it. Same thing in the mortgage industry. You can literally go online and do a digital mortgage experience and never have to talk to a single human being. But what do you do when things are broken, or you have a complication that it cannot figure out? So anyway, I'm not worried about automation, because at some point in time, not everybody's going to fit an automated model.
Well, most people, and I know the younger generation is more in tune to the technology world and automation, but most people don't want to do complicated stuff, especially financial stuff. They don't want to do complicated stuff without actually working with somebody. So I'm like you. I don't think that, even though that's available for certain people, I don't think that's going to take over our world of finance at this point. When I say finance, I mean everything: insurance and mortgage and banking and the overall world.
Advisory and portfolio balancing and all that. Exactly.
Yeah, absolutely. So we've kind of touched on this a little bit, but share with me, Ryan, how you would describe somebody that's just kind of average in the business versus somebody that's really good. What separates somebody, the value proposition, and what you kind of bring to the table versus the average out there?
It's a long road to get to that simple question, which is
I'm muddied up pretty good.
No, it's good. Right now, and this is 2022, right? The very beginning stages, and interest rates are going up, so we're going to see what happens here. But it's just like when times seem good, everybody jumps on the wagon. And you can see this in real estate agents, you can see this in mortgage lending, you can see this in any industry that's having a boom. A lot of people will come in thinking this is, a way to get money and to make money really fast, or there is no get rich quick in any sustainable business. It's get rich slowly, obviously, but do the right thing. Have some integrity, number one. Number two, it's have a moment of understanding and empathy. A lot of people will come into this industry and will start thinking that they're gonna get rich or do whatever, but they don't realize they've got to take time and invest in relationships with clients. They've got to take time and invest in themselves by learning all the rules or learning everything that you've got to do to be successful. That's number one, the answer to that question. The second part I would say is it's that whole crutch of leaning on a platform sometimes that becomes disabling to somebody being a better loan officer. So it's once again having that ear, it's once again having that ability to ask questions, and that takes time. To learn how to even ask the right questions takes time. To navigate a problem always helps to have experience in the same arena. So there's no like get rich quick. There's no whatever. Empathy, time, patience, understanding all come from practice, and they all come from being there and having the experiences of it. And not to discredit the guy or the gal sitting there working for a mega lender or in a bank as a captive person.
Right.
But also you lose something when you have a 9-to-5 regimented job that's paying a very normal salary with a benefits package, and you're completely handcuffed by your computer and these mega systems that don't actually allow any navigation towards the client-centric model. So
Right.
it's a good loan officer and a bad loan officer. It's just like a good realtor and a bad realtor, a good car and a bad car. You'll know the difference. Like a well-built home compared to a terribly built home, you'll know the difference when you walk in the front door.
Yeah.
You'll see it instantly. So that's
Absolutely.
the long way to answer that very simple question. Sorry.
So we touched on this a minute ago, the secondary market. You want to go a little bit deeper into what the secondary market actually is?
This is a great question. And, I'm going to disclaimer. I know enough. I know a lot. I'm pretty versed in all this, but there are people much smarter than me. You have to realize the mortgage industry in just the United States is over a $13 trillion market. $13 trillion roughly worth of mortgages on houses in the United States. That's big.
Right.
The lion's share of those are, at the end of the day, owned by Fannie Mae or Freddie Mac, which are not the government, but they are government-sponsored enterprises, meaning they have the backstop of the U.S. government. So all mortgages turn into fixed rate return items, which is a bond. All mortgages get turned into bonds at the end of the day, which are then sold by Fannie Mae and Freddie Mac. And that mortgage market is huge. It trades every day. It's highly liquid. That's the point and the intention of it. So a highly liquid model can make for quick turns of folks borrowing money. So you'll never have the problem of calling in your lifetime or me in my lifetime of saying, hey, can I borrow money? And we'll say, we don't have it available right now.
With the exception, you're a little bit younger.
Well, there you go.
So back in like 1980, 81, 82, that was the situation. Money wasn't available. When it did become available, it's like a new bond offering, and if the realtors weren't right there on the doorstep pounding on it, they didn't get
missed
money.
out. Right.
And so they had buyers wanting money, but they couldn't get it, and mortgage rates were crazy back then.
In the teens.
Yeah,
People were happy to get
It was unbelievable.
double-digit mortgage. They
Yeah.
thought they were lucky to be in the 11s and 12s.
So I agree with you. Hopefully, we'll never return to those times again.
That's true. That's true. You've got a good point. And we could go historically in the economy about the gold standard and when we came off of that. But
Right.
money is available. It's a highly liquid market. Remember, it's a $13 trillion world, so industry in itself. The secondary market is where we place all loans. Okay? In terms of folks like me who own a loan, but then we do sell it to replenish, once again, that liquidity,
money
to
going,
keep
yeah.
that money to where we have that money available to lend again to someone new.
Right.
And we've seen this, right? The interest rates are so low right here, and they trend up, they trend down. The value of those are just like bonds. So high interest rates obviously have a higher premium. Low interest rates have a lower premium. But for folks like me that have a lending industry or have a lending business, we don't want to literally lend and hold in portfolio rates when they're super, super low, because
They may go up.
yeah, exactly. They may go up, and there's disparities. So the secondary market plays just like the bond market does. So when interest rates are high, the value of lower returning things are even more diminished, and vice versa. When interest rates are super low or have a really low term, the value of those higher returning rates diminishes because everybody's going to refinance out of it. You don't have the stability of the income stream from the higher returns. So it's highly fluid. We could talk about it in crazy depths and details, but the only thing to remember for everybody out there is we have loans that pretty much either go with a Fannie Mae, Freddie Mac, or a government like a Ginnie Mae
Yeah, Ginnie Mae's
institution
another big-
that will take USDA and FHA loans, or
Right.
sometimes VA loans. All of our stuff is coming from the same place. Whether you're Quicken Loans, Midwest Capital Mortgage, Ryan Chambers, Bank of America, Wells Fargo, we all get our loans sold or insured by Fannie Mae, Freddie Mac, VA, Ginnie Mae, FHA, all those loans. So we're all trying to get into the same club, is how I've said it. It's just which door do you want to try to get into?
Right.
So the answer is the secondary market is really controlled. So that means we still have to play by those sets of rules. That still the Midas rule, like who has the gold rule. So when Fannie Mae and Freddie Mac say, if you want us to buy your loans, you have to make them fit these standards.
Right.
So that's why we underwrite to what seems to be a very narrow channel per se, but at the same time, it's created the standardization that made the market become liquid.
Right. So that's why it's a lot stronger market now, more liquid than it was back in the 80s. when that
Absolutely
happened
right.
before.
When it was a bond and that realtor was running to the door to get the bond money, they would say, "Oh, don't worry about this." And that's when things like your assets mattered. And like when people will call me talking about commercial loans, I'll say replace the word credit in a commercial situation with the word relationship. Like you don't have to have credit with your banker, you have to have a relationship with him.
Right.
So instead of saying like, okay, well, if you fit this box now with Fannie Mae or Freddie Mac, I'll guarantee you the loan and we can do it as many times as you want to. So there's just a quick difference there between like a primary market is when the bank holds your loan.
Okay.
The secondary market is when I will take your loan, bundle it, and sell it with other people's loans to a servicer who eventually sells it to Fannie Mae or Freddie Mac.
Gotcha. But it definitely keeps liquidity in the system, so that's awesome. So, and you always watch the rates. I'm going to ask you kind of more of a timely or time-sensitive subject with the rates going up now.
Dramatically.
And, you and I talk on a pretty regular basis, and we'll just be chit-chatting, and I say, where are the rates at? And you watch them throughout the day. And I never realized before I knew you how fluid the mortgage rates were. Can you describe that a little bit?
So, because of the way our whole system's been built, it trades just like bonds. So when we have interest rates increasing and all the factors influence that, inflation influences the prices, the federal funds rate influences the prices, liquidity, everything influences the prices. They move all day, every day, 5 days a week, basically kind of follows the bond markets, but they move all day, every day. And we have to watch the reports just like you watch reports of your own for your own customers that are going to influence us. Inflation is the number one killer of any bond or any fixed rate return product. So we have to always be paying attention to inflation
Or rising rate environment. Same thing.
Absolutely.
Yeah.
And so, the Fed's decisions always influence us. There is a whole market that does nothing but trade these bonds because every coupon, we call them coupons when you're really boiling it down and putting a mortgage inside of a bond category, right? It's on a certain rate of return. Every coupon trades very quickly all day because they're bundling these in the secondary market before they take them and put them into Fannie Mae or Freddie Mac at certain times.
Yeah, and they're a preferred asset in most cases because
And
they
they
have
are.
been highly qualified. They're backed up by real assets.
100%. You're at the end of the day, you are backed up by the collateral, the real estate value of whoever borrowed that money. And now you're also banking on them to make that payment, which creates the income stream to pay that bondholder who lent the money in the first place.
Yeah.
And just because we can talk about historical perspective is, I was in the business in 2008 and through 2010 and 2011 roughly. The fallacy was back then is your real estate value will never go down. Well, we learned that real estate values will go down. And what happens then is, that value of that asset just got even that much more clipped because the value of that real estate went down. So now we say, well, we lent out this much money to this person, but the value is actually, so people became literally underwater.
Oh yeah, a lot of people did.
And that
and then gas prices went up, and they couldn't afford to make payments,
and speaking of
unemployment
time,
started happening, and the whole thing fell apart.
I hate to say it, but we're kind of in a weird
Yeah,
similarity
it
moment
is-
right
yeah,
now.
it's rhyming a lot.
Gas prices are once again really, really high. Rates are going up at a quick pace. In the last 2 months, though, too, and in case somebody watches this 3-5 years from now, they'll go, "What are they even talking about?"
So again, this is late March of 2022.
The
If
rates.
the whole thing blows up again, we're very prophetic. Right?
Exactly.
We're not predicting that, but I do think there are some potential recession on the
last
mortgage
3
side.
months of rates have really gone through the roof. And maybe even so that it's overreactive in the secondary market, maybe.
Yeah, it might be a little bit of a knee jerk, hopefully.
It might be a little bit of knee jerk, but the Fed's talking about 4 rate increases, which means the Fed funds rate gets that much higher, and bonds and treasuries are still tied to the Fed funds rate in their own regards. So we're going to see what happens, but it's a confluence of higher interest rates, which diminishes borrowing capacity for a lot of folks.
Yeah, it starts marking people out of the market, or they can no longer buy as much of a house as they thought they could.
Correct. So that's going to create some natural deflationary pressure.
Right.
Gas prices
Supply
are
will
up.
open up a little bit more.
So people's disposable incomes are down.
Mm-hmm.
So, anybody who may be overspent, which is always still a concern because we had a craziest real estate market anybody has seen over the last 2 or 3 years.
And nobody expected it coming out of COVID. Or
Nobody
not fully out of COVID,
expected
but
it.
who would have thought that, you coming out and you still have COVID going on and the new variants and so on and so forth, but the housing market just
Goes
blew up.
crazy. That is a concern. I think a lot of people are saying is they say, okay, well, they overbid for that house or
Mm-hmm.
they paid more than the asking price. And if we have a correction, well, those values are going to. Now, the difference I can tell you for sure that I know is between 2007 and let's just say right now is mortgage default rates are the lowest they've
Mm-hmm.
been in decades. And the credit quality of every loan written over the last decade has not been as good as it has been either. So they're the same thing, right? They're symbiotic. More default rates are down and the credit quality's up. So we're
You
trying
kind
to
of said that the way around. So right now you feel like the credit quality of what's
is the
out there is
highest
good.
as it's been,
Yeah.
and the default rates are as low as they've been.
Yeah.
So personal prediction prophecy is it's not. We're not going to have another 2008 moment.
Right.
We're not going to see real estate crash. We're not going to see it go whatever. It will for sure level out.
Mm-hmm.
People buying a house today cannot expect to get a 20% increase over the next 2 years. I don't think that will happen.
I think this spring season is probably going to be the peak, in my opinion. The peak of the housing market is probably happening between now and May or June, because people are going to start running to get that house now before the rates get too high from the Federal Reserve.
Right.
So it's going to be kind of like a last minute spike, musical chair game. Let's get that done before this gets worse.
There's always that. We have two types of people who call us when they talk about interest rates. There are the people who say, let's act now before they get worse.
Right.
And then I've got the second category of folks who are saying, I'll just wait because they'll get better. And you say, well, there's got to be, somebody's right in the middle
somebody's
there.
always right,
Somebody's always
wrong.
right. But at the same time, I don't know how to advise folks when I say, okay, well, I don't think they're going to get better.
Mm-hmm.
And it's not a sales technique or a pitch, but you say, they're going to be high. The rates are going to be high for a while just because of fundamentals.
Well, we're coming off the bottom. I mean,
Yeah, we came off the bottom. There's only one direction.
Inflation's high. They're trying to dampen that inflation now. So over the last, we've probably, you've been part of my consulting group for the last 10 years. And over time, when we've done, personal banking or mortgage with you, you would, to a certain degree, we would kind of shop the rates and say, well, I've got this right now, but I think another week or so it's going to be better, or the case might be. Right now, you can't really do that right now because it's very likely going to be the same or more for the next foreseeable, I'd say 12 to 24 months. It's probably going to be a slow, steady kind of increasing. There'll be some day-to-day fluctuation, but I think overall the trend's going to be going up.
There's day-to-day fluctuations every day, all day, like we talked about. That market's trading all the time, but I think we've hit a new base floor for sure.
Mm-hmm.
And you're right. It's now seems like it's smarter to advise clients and say, if you're thinking about a purchase, if you're thinking about something strategic for a need for a refinance or whatever, it might be the time to do it now because I don't predict interest rates to be any cheaper in 1 year from now.
Yeah, I'm afraid that's going to be the situation too as well. So to kind of wrap this back up to people that, what does the person that maybe they're going out for their first loan and have never dealt with getting a loan before, or whatever the case is, what are some rules of the road, best practices the consumer should know when they're interviewing and deciding what they're going to do to be able to get the best possible mortgage for their home?
This is great. And like that fundamental education, if you could even take it back to like saying, I wish people's parents would have taught them this or the high schools would have taught them this.
Right.
3 or 4 things, obviously. Number one, pay your bills on time so you have a good credit score.
Right.
The better your credit score, the easier life is going to be, let alone easier it's going to be to
A lot of things are affected by that.
Everything is affected by your credit score nowadays.
Even the car insurance you pay, they charge
your
you more
home
if you have
insurance
bad
is
insurance.
still tied to credit scores. Your car insurance is tied to credit scores. Mortgage rates are tied to credit scores.
Jobs.
Credit card. Nowadays, people even get their credit checked for getting a job. So paying your bills on time is the number one thing that you tell anybody who's a first-time buyer. And saying, well, I know I'm going to buy a house in 5 years because I'm going to meet the love of my life and we're going to settle down. pay your bills on time now. Number one, try to save some money. And then, 3, keep your employment steady.
Right.
If you're going to be complicated and own that. Be complicated for 2 years, right? Self-employment guidelines, keep your employment in the same arena for 2+ years before you really apply for a mortgage.
It doesn't mean they can't change a job.
Absolutely.
If they've been in the restaurant business as a manager, whatever the case is, and they change companies to another one,
That
the
is
same deal, that's
totally
fine. But you don't want to be going from being a car salesman to a real estate agent to whatever, right?
Absolutely.
Within a short period of time.
Anytime you're in a W-2 situation, you're fine.
Yeah.
If you're an employee of a company and you change jobs because you're leveling up, right? You're getting to the next best thing, that's absolutely fine. You can change jobs 30 days before you apply for a mortgage and you're okay. It's those self-employed folks. Try to get your financial house in order for 2 years or your income stream in order.
Right.
And specifically for self-employed folks, I don't want to go down that route too much, but you don't always have to have the 2 full years of tax returns. But at the same time, you need to be stable and show income. That's the whole thing. Like, we can make tax returns work and understand them better than anybody, but folks that make no top line income have no bottom line income either.
It's hard to loan
I
to.
cannot get loans done for that.
You're really great, but you're not that
I'm
good.
great, but there's no magic trick that says if you don't have some kind of income to support, we can't get the loan for you. So keeping that in mind for self-employed folks, pay the bills sometimes, make some money, save up a little bit.
Have some kind of a down payment.
20% is what it used to be. The gold standard of everybody who went to the bank in 1980 said, I had to have 20% down, I have to have 20% down, I have to have 20% down. Nowadays, it's really, you don't have to have 20% down, and you can always try to figure out where's the best allocation of your cash personally for each individual person. But 5% is kind of the minimum, the gold standard minimum at the moment. Obviously, 20% is better because you avoid something called PMI, which is private mortgage insurance. It's no benefit to the borrower. It's mortgage insurance that I make people buy in case they default. And that's a Fannie Mae, Freddie Mac rule. So you want to avoid the PMI by putting 20% down, but you don't have to, because if you have that good credit, if you have a good job or you have decent income compared to your debts, the mortgage insurance is pretty cheap nowadays.
Yeah,
it's an insurance product at the end of the day. So those rates are classified based on risk, and there's less risk, and there's a battlefield in there too. So they're always bidding, who will take on that risk for the cheapest price. It's not the end of the world to not have 20% down, but bigger down payments are just part of somebody's strategy.
Right. I'm glad you brought that up, because this is one thing I try and counsel our clients on. If they have a mortgage out there, and I'll ask them, what do you feel like the home value is right now and how much you owe? And a lot of times they may have had PMI, maybe they went in with a 5% down or with some kind of a loan to begin with. They have the PMI, but because mortgage rates or the home values have gone up dramatically, like we talked about earlier in this market, they may be in a situation. Some of you watching this may be in the situation where you now have enough equity to get that PMI taken off, and the mortgage company. Not you, but Fannie Mae or Ginnie Mae or whoever's servicing it, they won't service. But I mean, if whoever you're servicing, Mr. Cooper or whoever it is, they're not going to, I don't think, automatically look at removing your PMI, as quick as it probably could come off if you push the button and ask about it.
So the rule book says, is if you have 20% equity, you can remove your PMI. Now because it's insurance and they want to make it as profitable to them as possible, it does not automatically cancel until you reach 78% of your original loan value.
Okay, so they don't give you the equity side on it unless you ask about it.
Yeah, they don't know about your equity. It was still based on that purchase price.
Gotcha.
And it's according to the amortization schedule. So the day you were scheduled to meet the 78% will be the day they say, okay, now you can get rid of your PMI. So that's the caveat, right? Otherwise, you have to request it, usually verify the collateral, meaning getting a new appraisal. But because it's an income stream to insurance companies and everybody wants to have that protection as a servicer goes, they say, well, let's make them get a new appraisal. Let's make this a little bit of a complicated process. And sometimes it's, depending on your servicer, sometimes it's relatively easy, and sometimes it's a lot more complicated than it needs to be. But in that exact situation you spoke about, folks that bought a house let's just say, throw out a number here, in 2018,
Okay.
had this benefit of great appreciation rates. Their house value's gone way up. And let's just say they might have been in a one step below a perfect credit score back in 2018. Well, they're paying a little higher PMI rate
Right.
than what is available even now.
So the PMI is geared off their credit score also?
Absolutely. PMI
Okay.
is completely tied to your credit score.
Wow.
And it's not a standard carte blanche number for everybody. So that person in 2018 might be paying a slightly higher PMI rate. Now they have the equity to not even be in a PMI situation. So
Okay.
sometimes those folks can call us. We can really go through their numbers and say, we can actually take you to a 20-year loan for the exact same payment and remove your PMI.
Right.
And you're in the same boats, and you've now gained, since 2018, you've now gained 6 years ahead on your schedule for mortgages.
Save tons of
and
interest.
saves tons of interest over that next 20-year period.
Yeah.
And then some
I mean,
people,
you saved some of my clients $50,000-$100,000 in interest by just doing that
100%.
same type of a refinance strategy.
if you look at a mortgage written at 5.5–6% on a 30-year loan, the amount of interest scheduled was an insane amount.
Right.
And then with the lowest rate environment, when we put people on 15-year loans, there is $100,000+ delta there for sure on more in certain cases.
One of the things is, and I don't know how it is now, but it used to be there was like 7 different ways to have scheduled interest applied. And one of the smarter ways for in a lot of cases are if the mortgage company allows you to make 2 payments a month, which gives you 26 every 2-week payments.
Biweekly.
Yeah,
right.
the biweekly, then you're actually making 2 extra payments a year. You don't really feel it too much probably, and you pay off the home a lot quicker. The other thing is, like, sometimes people say, well, I want to pay extra money on my mortgage, or maybe I want to pay extra money on my credit card or whatever debt, to pick your debt, right? But you want to make sure you're applying it the right way. And some of the companies would, in the old days, I don't know if this still happens this way or not, but they would apply the extra payment to the 360th payment on a 30-year mortgage, as opposed to the beginning and then resetting it. So the scheduled interest programs are different depending on how that is structured. Am I on the right track here? Is this something that
absolutely.
you see a
So,
lot of?
At the end of the day, and I've actually done this ran out all the numbers and did a video on this myself there is a fallacy now. We sell what's called a fixed amortization schedule loan product. Okay, so, and that's one benefit we have, which is that as a Fannie Mae, Freddie Mac lender, is you're going to pay interest based on the schedule of let's just say it's a 30-year loan, a 30-year mortgage.
Okay.
Every month that you go down, it's called the discount factor. That's how you end up bidding towards 0 at the end of that 30 years.
Right.
We have the set amount of interest based on 30 days a month or 365 days a year. So you're going to pay that same. So how you get ahead, the day you write $1 over your minimum payment, it goes towards your principal.
Good.
So how we throw people ahead and they pay their loans off faster, pay less interest, is you pay down your principal faster and you basically move on that schedule down. So imagine the triangle, and you're paying down as you go, and here comes your principal balance. So the day you do it, you kind of throw yourself down faster.
And paying a little bit early probably helps too, right?
Paying, well, no,
Or
because
it's a
it's 30
fixed
days
schedule.
no matter
So
what.
it's not
you're-
like a credit card.
It's not a credit card.
Yeah.
So the difference between a primary bank who lends you money in the old days is they're literally charging interest on a daily basis.
Okay.
So you're calculating your balance and you're saying, here's my interest rate. And we're paying that amount of interest every single day. The bank will then literally calculate every month how much interest. So the bank sometimes in the old school days and on certain lease products and whatever else, when you paid extra, all they would do is just say, well, we're counting this towards your future payments. You're prepaying interest, but not your principal. And that was their kind of gotcha to keep balances around so they could keep daily interest as high
Right.
as
People
possible.
thought they were making an acceleration. They really weren't. They're just nicking off a little bit of the very last payment on the
Right,
mortgage.
and that's somehow, and that's not how our loans have worked for years.
No,
and
I know
years
yours
and
don't.
years now.
Yeah.
And like the local bank will still charge you interest on a daily basis, a per diem basis. So the only way to achieve the exact same schedule is to literally pay your mortgage payment on the exact same day of the month, every single month, every 30 days. And then it would function the exact same principle as ours. That's the only way to make those two identical. And then every time you pay the extra principal, you'd have to figure out your own discount factor and figure out your own principal to do it and figure out your daily interest.
Right.
And most people, because of holidays, because of life, because of whatever, cannot pay their payment on the exact same day
Right.
every single month. Now, there's a lot of folks that are super responsible, pay way in advance and all that kind of stuff, but at the same
We're
time,
automatic payment set up.
it's just the way that they're fundamentally set up, whether
Mm-hmm.
you take interest on a daily basis and it's calculated that way, or whether we, like us, have a fixed amortization schedule. And if you do it the same, like I said, you will spend the exact same amount of money.
Mm-hmm.
How we get you ahead is you pay extra, it goes right towards principal, you throw yourself down the progression line faster.
Gotcha.
And so at the people that are on a variable rate, that throws a whole nother monkey wrench into the
And
whole
you have
thing.
no vested interest in them having a loan longer or not.
No.
You've done the best you can get, and you're getting the best rate.
Absolutely.
And then you're eventually selling it, and it's going to end up a Fannie Mae or
Freddie
whatever.
Mac, and I
So
have
you-
no ownership of that loan anymore. So
Right. Yeah.
my alignment is with the client saying, I want you to not have a mortgage payment someday because I'm done. I mean, if once they're done with me, I have no ownership of that mortgage. I want them to be debt free so that way they can go do whatever they want in
Get
life.
that second home.
Get your lake house or get whatever else
Right.
it may be that you need to call me back for. But absolutely, it'll pay off quicker if you just add extra to the payment. Now, going to that one thing you said, when the interest rates were as low as they were, making that extra payment never worked out to be the math. I did it too many times where you wouldn't save 7 years by making that extra payment.
Mm-hmm.
Those 2 extra payments a year don't cut off 7. It was more like 2.5.
Yeah.
So that's a bit, maybe whenever you couldn't apply that extra towards that principal, but to really run it out on a real amortization schedule, extra payments always get you done faster. But if you could add, 5 payments per year, roughly, just towards the principal, that's when you'll cut off the 7 years.
Gotcha.
So,
Okay.
just roughly.
That's good to know for everybody. So a last question, but me, I'll ramble on for some other. This will open up a few more doors. You're pretty consultative, and that's where we work together with clients in a lot of cases. You're pretty consultative about maybe a way to use mortgages as part of your financial portfolio or plan, and kind of more in-depth, big picture thinking. You want to share some of that with everybody?
So, real world example for you and me is we've got a customer who, mutual client, who is maybe at that magic bubble of they don't want to quite turn on Social Security yet, even though they're old enough, but they've
Right.
got a portfolio. And we don't want to take all that money out of that portfolio to go buy the house with, just because they don't really have an income stream turned on yet. Well, we would look at it and say, okay, well, why don't we look at maybe bridging this with a different type of loan product, or just turning this on for a brief period of time here to get you qualified to get you into the house,
Right.
and then actually keep those assets growing because they're at a very critical time
Well,
of their retirement picture at that moment.
Yeah, because the
sometimes.
market is averaged. If you just track the SP 500, and there's a measurement of going back over 100 years of what the 500 biggest companies in the United States have done from a stock growth standpoint, it's around 10% per year on average. Right?
Right.
Some years are down, 10, 20, 30%.
Right. Over the long haul.
But in the long run, 10% averages, and if the mortgages are running, 4%,
It's
whatever,
just
just financial numbers
You
are
have
better.
to, and that's one thing we do. You do well. I do relatively well. Is you always maximize your dollars. What's your lowest cost of borrowing? What is your opportunity cost by not having money in the market? You've got to look and kind of sync them all up and say, what's the smartest thing to do? Sometimes we say, hey, don't go pay cash for this house, because if we get you out of the market now, I feel like we're going to miss out on an opportunity for 11% year, or whatever the case may be.
And
So
you may get some tax break on the mortgage.
sometimes, now that's kind of
Interest
gone
rate.
away with
Yeah,
some of the standard
some of the caps
deductions,
and whatever,
some of the
but-
caps they put on in place.
Yeah.
But just for the pure fundamental portfolio analysis, a pure financial health analysis, you always want to borrow at the cheapest rates, and you always want to maximize your assets earnings power. So having more money in the market might be smarter for some folks compared to paying cash for a house and taking money out of a portfolio that's doing well or has some kind of upside potential. And for the young folks out there, those first-time home buyers, it'd be, get in, borrow at the cheapest cost by having the good credit and all that stuff, but get with Bruce Glenn or get with a financial advisor that says, let's start a habitual pattern of saving
Yeah.
That way we're doing everything at once. We're paying off a loan and we're growing assets at the same time.
Yeah.
So we can have a really fun conversation in 20 years about what it is you really want to do.
Yeah.
And figure that out. So start saving early is my other advice.
And that's one thing we do with most of our younger folks, especially, is they saving so much money per month. We call it a periodic investment program, and it works great because
Right.
over time compounds, and that you eventually have the kind of money you want to have if you're saving at the right pace, and of course do it through your work as well. So anyway, great stuff, Ryan. I appreciate it. Any final thoughts? Anything you want to touch on that I didn't maybe dig in on?
Man, we covered a lot. You know, we can kind of go down some rabbit holes, obviously, but I think, you know, at the end of the day, keeping it simple is probably your best option for borrowing money at the end of the day. And we're dealing mostly with fixed rate stuff, so not overly complicating a situation makes the most sense.
Mm-hmm.
And you know, paying extra, keeping it basic, I think, is the smartest thing that we can all do. But and same thing with giving you money. Keep plugging away. Keep
Right.
growing your portfolio slowly but steadily.
Yeah.
This is not a quick game in the mortgage world, nor is it in the investment world. So
Absolutely right. So we've probably touched on several things that some folks may have some additional questions about. Ryan, how do they get a hold of you?
the website or a phone call is great, or an email. Just get a hold of me, and it's, you know, we really take pride in, we are real humans. We like to actually talk to people. We
Right.
like to actually ask a couple of questions and figure people out. So we would love that opportunity just to talk and have a conversation with anybody out there.